Hello everyone and Happy New Year. This is my first video blog for 2021. I haven't made one of these video blogs in a few months, so I'm sorry about that. It's been lot of going on, but I think it's probably a good time to share some of my thoughts on what's going on in the marketplace, the current marketplace. And my God, it's been quite volatile, quite interesting. We ended 2020 with kind of a down note about what the world is going to be like, and there was a lot of uncertainty. And we entered 2021 with these crazy natural gas prices. So I think it's important to kind of break down not only what's going on, but what it means for the marketplace. There's been a lot of people talking about why it's happened, and the whys are obvious. It's cold in many parts of the world, shipping is tight, there's not a lot of storage left, Asian demand has rebounded quite well, the list goes on. But I think it's important to understand the implications of what this means and what the lessons learned in all of this are. I read just a few weeks ago, someplace, I think it was a McKinsey report that talked about the timing for peak fossil fuels. And they said the timing for peak oil is probably about now, or it's just passed. So peak oil demand is now on its downward slope. And I think that makes sense. But what it said was quite interesting. Peak gas demand, we will not see that until the 2030s. So we still have another decade of growing gas demand in the world. And we see evidence of that everywhere. There's a lot of people around the world who are still very interested in looking at gas to replace coal for power generation, looking at gas for petrochemical uses, looking at gas for expanding city gas grids, and of course looking at gas for transportation. And remember, a lot of the electrical vehicles we see today are powered by electricity, and electricity will come from gas. What is worrying to me is, in my view, have we seen the peak of gas investment? There's a perception, rightly or wrongly, I think wrongly, is that we have invested all we need to do and now we just can ride that investment. Well, what we have seen is that we haven't invested enough. This volatility, this massive change in natural gas prices, represented by a proxy of JKM, whatever that you think that proxy means. But the fact is that the JKM spot price in Asia has gone from $2 in the second quarter of last year to $40 today, or $30, whatever the number is, tells me that the market is not stable, that the market is very tight. There's not a lot of slack on either side, supply, demand, or price. So it doesn't take much externalities for the prices to go crazy. It also tells us that we are underinvesting. And this underinvestment is going to be a problem. How are we going to satisfy this upcoming rising demand for the next decade of natural gas if we don't also keep up with investment, especially when the investment has a long lag factor of 3 years, 4 years, whatever the case might be. In the last 12 months, we have only seen sanction of 3 million tons of LNG, and that's a project in Mexico. Peanuts in a marketplace of 300, 400 million tons. This is not really going to work. We can't be expanding our investment in LNG supply by 1% of the volume of LNG and expect that to satisfy the increasing volume, increasing demand, which is growing at 5-10% a year. So something has got to give, and I think what we're going to see is a lot more volatility. Another thing we have seen, of course, we've talked about this in the past, is the players have changed, of course. In the old days, it was supplier of gas selling to the buyer of gas. Very little middleman in the way. Whether it's pipeline or LNG, it was all pretty much the same. In the US, of course, you were selling, a supplier was someone taking it off the grid, not the producer, but it was still a supplier selling to a buyer. Now, especially in the LNG world, we have seen the growth of the portfolio player, the trader, the intermediary. Yes, you can argue they make the market more efficient. They allow countries and buyers with not so great credit to buy LNG that they otherwise couldn't. But we have to remember their business model is based on volatility of prices. They need prices to change, preferably from low to high, so they can buy low, sell high. They don't make a lot of margins when prices are flat. When prices are flat, you don't really need a middleman in the way. You know what the price is, you go buy it from the seller and you're set. The middleman helps you because you think that he's going to help take some of that volatility away, but in essence, I think they actually create the volatility. Or if they don't create it, they benefit from the volatility. So we have seen more and more the marketplace dominated by these middlemen, and these middlemen thrive on volatility. So I'm not surprised at all we have seen this crazy volatility. But the lessons are also a fewfold. Number one is diversification. Diversification is absolutely the key. We need to think about how is the best way to manage a volatile price environment. And the best way, in my view, is to diversify. Diversify your supply sources geographically, diversify them by contractual length, some short, some long, some medium, and diversify them by the indexes or the indices that you link the two things to. Now, you've heard me speak for many years about the fallacy of linking oil prices to natural gas prices. And what we have seen the last few months is a great example of that fallacy. What have we seen? We have seen oil prices go up from, the $20, $25 range to the $55 range, doubling of prices, a bit more than double. If you were buying oil, natural gas or LNG on oil linked, you've seen a $30 increase in oil. And if you were buying at a 12% link, you've seen a $4.50 increase in your absolute price of LNG that you receive on things that are not on an impact of a factor that is not related to your market. Your market is, you are buying LNG, you're buying gas for your power supply. But unfortunately, because of your underlying index of oil, and oil has gone up for various other reasons, and you can see it's political. Saudi just announced a cut in their production, etc. You've seen oil prices go up, and now you're seeing your prices go up. And of course, what do we see? We see the traders jumping into this and now offering oil-linked prices for the marketplace at crazy links, 20-30% links I've heard. And remember just a few months ago, the Qataris were selling it at 10.5% link or 10.2% link. So, really shows to me the fallacy of trying to link natural gas and oil price. We need to really get away from that. It doesn't make any sense. And let's just say, for argument's sake, that you had just bought from you bought from a US Permian supplier. The Permian prices have also doubled. So percentage terms, the commodities have doubled as well. They both doubled, oil and Permian. But Permian's doubled from $1 to $2. And so that, if you are buying FOB, let's just do an example. You're buying FOB oil link, FOB Permian. FOB oil link, you would see a $4 to $5 increase in your FOB price because you're buying 12% of $30 increase in oil price. FOB Permian, you just see a dollar increase because Permian is not multiplied, it's just a straight pass-through cost. It might be multiplied by 115%, but that's okay, it's $1.10 then. So look at the exposure. Yes, the underlying commodity has risen by the same percentage, but your FOB price has gone up fourfold if you bought oil link. So I guess my message is, you buy oil linked. Most of the time, it's not that great. There are times that it's great. When oil drops to 20 bucks, you're laughing, you're happy. But it's like the casino. You go to the casino, sometimes you win, but most of the time you lose. And I feel the way we look forward with oil link, sometimes you win, but most of the time you lose. So I'm not advocating only that you should buy a US link. I'm advocating you should buy gas linked or contracts. If you want link to JKM, great. You want link to TTF, that may be your marketplace. You want link to the price of gas in the place that the LNG is being produced, such as the US Henry Hub price or the US Permian price, that's what makes sense to me. But we still see people trying to sell oil link prices. And I could venture to say, and I don't know this for a fact, that the Qatari expansions that now look more interesting are probably going to be majority at oil link prices. That's what the Qataris want, that's what the Russians want, that's what they usually get. So this is also an interesting point. This recent spike in prices have given a new vigor to the Qatari expansions. I would have argued that late last year, the Qataris expansion were not looking as sure as everybody thought they were. Well, when an LNG price goes to $40, it's looking pretty attractive for the Qataris right now to go out. And they have the money and the partners to go out and build these projects on spec without the long-term deals signed by the buyers. So they're willing to take that price risk, and especially if they control so much of the market, they can actually control a bit of the spot market, and they'll benefit from these crazy spot market prices. So the longer the buyers hesitate to sign long-term deals on non-oil linked prices, the more power we give to the trading companies and to the large equity, largely state-owned enterprises that want to sell on oil linked prices. And I think the more we ensure that the future is going to be pretty damn volatile. And I don't think volatility helps anyone. The volatility, if I was a buyer, I wouldn't know what to do. Do I sign an oil linked at $10, 20% when I could have signed 10% a few months ago? Do I sign a short-term deal, but then I'm totally exposed to I don't know what the price is? It makes it very difficult. So most sellers hesitate and they do nothing. But this is what is funny. Last year, the prices were so low and the sellers were hesitating. That's when you should buy. They say, Warren Buffett said, buy when other people are fearful. This is when they should have bought, but of course we didn't. And in fact, to add insult to everything, people cancel the cargoes. We cancel American cargoes because we could. Other places, they don't even let you cancel. That shows the power of the flexibility of the American system. But they cancel the American cargoes. Now imagine if some of those cargoes were not canceled and that LNG was produced. When it canceled, it just never got produced. It just went into the American gas grid and got shut into production, stayed in the ground, whatever happened. So the cargoes were never produced, the LNG was never produced, and so it could never be stored. And it could never be stored. And imagine if you could have stored some of that and now bring that out in the marketplace. Now you would be making a killing. Okay, I'm sure people are going to say, well, you can't store LNG. It costs you the boil off gas, etc., etc. But yeah, okay, so I lose 0.1% a day. Every day, 10 days, I lose 1%. Every month, I lose 3%. Every 4 months, I lose 12%, 10%. But the LNG price is, gone from $2 to $40. You would still make some fortune. So I guess, we see a lot of people kind of following and do knee-jerk reactions. One person decided to cancel cargoes, everybody decided to cancel cargoes. I don't think that was wise. You'd be better off keeping the thing going and we wouldn't have the spikes today. And now we're all suffering, we're all scrambling. So I guess my message is we're going to see more volatility. The volatility is here to stay. And the way we can avoid the volatility is for the sellers and the buyers to work together. The sellers have to give more flexibility and understand what the buyers face, but the buyers have to start signing long-term deals, and especially long-term deals that are not linked to oil prices. The sooner we can do that, I think the more we can get investments going again. We do not want to have peak gas demand 10 years away while peak gas investment already passed. We're going to be in for a tough time if that's the case. Remember, there's going to be a 3 or 4 year lag. So we need to think about continuing that investment. We need to make a lot more gas investments for the next few years. I'm not saying that the hydrogen economy or the green economy is not going to make a difference. It is. But natural gas is still going to be the fuel for many, many years for power generation. It's a substitute fuel for your dirty coal, dirty oil, and it's increasingly going to be used for transportation, marine, land, etc., etc. And we see more and more industrial users moving away from oil-based feedstocks to natural gas-based feedstocks. So I guess in closing, I hope 2021 is a great year. We need it to be safe. Look at all the vaccines, look at all that stuff, look at all the packaging that it's coming to. Most of that packaging of medicines and vaccines and the respirators, all that stuff comes in plastic. You know, we were all anti-plastic and throwing away our McDonald's straws last year. Well, suddenly, you know, we're all quite happy using plastic IVs and plastic tubes and plastic syringes now. So, you know, natural gas has an important role to play in all of this as well. I hope everybody stays safe, and we'll talk again in the next few weeks or months. We'll see how things go. Thanks again. Bye. Please leave comments, subscribe, and look forward to a healthy discussion.